Hi everyone, welcome to Chapter 3, Lecture, Computing the Tax. So I know Chapter 1 and 2, you might have thought we were going to jump into taxes. We were really looking at the broad system and all of the details that go into taxes being so complicated. So you have that foundation and context. And now in Chapter 3, we're going to go into actually computing the tax, and we'll be looking more at the full equation and how income taxes work. So first we'll start with a scenario that we'll kind of be referring to as an example throughout the lecture. A maintains a household in which she lives with her unemployed husband named Trevor, her stepdaughter named Paige, a family friend, Tara, and she is providing more than half the support for both Paige, her stepdaughter, so her husband's daughter most likely, and the family friend. Tara is fatally injured in an automobile accident in February, so that's the second month of the year, and this is the family friend that they're supporting. Aleha paid for her hospitalization and funeral expenses. Paige, an accomplished gymnast, her stepdaughter, graduated from high school last year. She has a part-time job but spends most of her time training and looking for an athletic scholarship to the right college. So in March, Trevor left for parts unknown and has not been seen or heard from since, and that was her unemployed husband. A sold her wedding rings to a cousin who was getting married. The rings cost $11,800, but she sold them for their value of $9,000. So it wasn't a deal, even though it was her cousin. Based on these facts, what are A's income tax concerns for the current year? So we're going to read the chapter and think about these situations. The tax formula. If you recall, we talked about this briefly in the last chapters. We're going to get a bit more specific about this entire formula in this chapter. So we're talking about a formula like this, this plus this equals this, but this is also going to be on the form. Our beginning is income broadly defined minus exclusions. Those are specific income items or income that we receive in value. Maybe it's not cash specifically, that we are allowed to exclude from being taxed, and then that brings us to gross income for taxes. Then less are deductions for adjusted gross income. So specific deductions that bring us to this important subtotal on our tax return called adjusted gross income. It's an important subtotal because a lot of credits, tax credits, limitations, and various calculations are based on this amount or an amount based off of this amount, often called modified AGI, for a specific calculation. So after we get to that AGI, we'll subtract the greater of itemized deductions or the standard deduction. We'll be talking more about this, but just for now, know you get one, the itemized deductions or the standard deduction. You do not get both, and unlike many equations in taxes, you get to take the bigger one. Typically in taxes, it's the smaller one, but this time it's the bigger one. Then we're going to subtract the personal and dependency exemptions. So obviously this hasn't been updated. You can see they put this asterisk instead of just upgrading the calculation. The 2017 tax changes in December got rid of personal exemptions. And of course these apply 2018 through 2025, so they can come back after that. part of why the 2017 tax changes seemed like they decreased taxes at first was because they made the standard deduction bigger. But if people talked about that without mentioning that they got rid of the personal exemption, especially for people that had a lot of children and dependents, they were able to take a deduction. And this isn't money back for people who didn't work. This was people who earned money, who supported other people, were able to take a $4,000 deduction for those people. But of course, that could add up. If you have 10 children, that's a $40,000 deduction that you don't have to pay taxes on for basic care, right? Then we also, so this is gone for now. So in your notes, when you write this out, you want to be sure to point out this is not here. What we do get to subtract is a deduction for qualified business income. And again, this is a really unusual type of deduction for taxes because it's based on 20%, a percentage of business income. And typically expenses are only based on things that you paid, an actual expense, and not usually ever based on the amount of income. So once we subtract this additional deduction, then we have taxable income. And then on that taxable income, we calculate our tax, and that's total tax. Then we get to subtract from that tax credits. And so notice that tax credits are a lot more important than a deduction. A deduction decreases our total income, while a tax credit offsets our total taxes. So we'll be looking at that more in problems. And then that gets us down to our net tax due or refund. And they didn't show here, this would also include less any taxes that your estimated taxes that have been withheld from a W-2 or that were paid in quarterly because you knew you were getting paid without taxes being withheld. Okay, so income is broadly defined as all of the taxpayer's income, both taxable and non-taxable. This is everything you get of value. Gross receipts is another term. And it does not include, a return of capital or receipt of borrowed funds. Borrowing funds is like taking out a loan, right? That a loan is not income because it's a liability, if you recall from accounting class. IRC, Internal Revenue Code, defines gross income broadly. It's all income from whatever source except as otherwise provided. So that means except if it's specifically excluded, it's included. Gross income does not include unrealized gains. This is something that will come up later on with buying and selling assets like a house. So when it comes to things that are specifically excluded from gross income, we have a list of things. So accident insurance proceeds. That's because you pay insurance on your vehicle, and when you pay for insurance, any payouts you get are not taxable. Alimony. So typically alimony was taxable income, and the person who paid alimony got to take a deduction for it, but that was part of the 2017 tax changes for divorces after 2018. Annuities, this gets a little complicated, but an annuity is a retirement plan you pay into. We'll go through these in greater detail. I'm just going to run through them now. Bequests, child support payments, which are not excluded. That's the way it's always been. So there was always a differentiation between child support and alimony, but there won't be any more. Cost of living allowance for military, damages for personal injury or sickness, Gifts that are received, the person receiving the gift pays no tax. Group term life insurance, premium paid by the employer for coverage up to $50,000. Inheritances, interest from sale from state and local bonds. Those are often called municipal bonds. Life insurance paid upon death. Meals and lodging if furnished for the employer's convenience. So if an employer throws in lodging, let's say a really nice place to live, just as part of your salary, that's actually got to be included in your W-2 for taxes. Or you have to report it at the end of the year if they don't. Military allowances, these are exclusions. So it's only excluded if it's for the convenience of your employer. So for example, I worked at an English school and I had free housing there because I was on call throughout the night. So that was for the convenience of the employer, and so I didn't have to pay tax on my free housing. Minister's dwelling rental value allowance. This is a specific amount they can exclude for their cost of their housing. Railroad retirement benefits. It's a very specific calculation similar to Social Security, which you see down here. Scholarship grants, that's also limited. Veterans benefits, welfare payments, and workers' compensation benefits. Okay, so we're continuing here of a partial list of gross income items. So these are things that you do include in income. So you can see alimony prior to so divorce is starting in 2018, annuities, awards, and this is the other side of a part of annuity is excluded, a part of annuity is taxable. Back pay from an employer is taxable. Awards are taxable. That often surprises people. A bargain purchase from an employer, meaning you got a deal and there's a portion that has to be taxed. Bonuses are taxed just like salaries. Breach of contract damages, business income, clergy fees, commissions, compensation for services, death benefits, debts forgiven, like if a credit card forgives or writes off a debt, director's fee, group term life insurance, the amounts over $50,000 coverage, hobby income, interest, jury duty fees, living quarters, meals, unless furnished by the employer's convenience, like we just talked about, mileage allowance in certain cases, military pay unless combat, notary fees, partnership income, pension distributions, prizes, and professional fees. So a lot of those were the opposite side. This is what's in parts included, part wasn't. Part was specifically excluded. And they continue. You can pause this to read through it. We'll be going into more detail as we go through here. So individual taxpayers have two categories of deductions. Deductions for AGI, that subtotal I mentioned, and deductions from AGI. So deductions for AGI are sometimes called the above the line deductions, meaning they're above that subtotal of AGI, versus deductions for AGI. So now they're giving us a list of these. They're very specific. We'll look at the tax return in a moment. Trade or business expenses are deducted from the income directly, and then the net amount flows into the tax return. Then further down on the tax return after total income, we have a few specific deductions for AGI. These are going to be more valuable than deducting things from AGI, right? Because AGI is used to calculate other sorts of calculations on the return for credits, for limitations, and so forth. So the lower AGI is, the more likely you can take bigger credits and qualify for more favorable lower income tax preferences. So that's why a deduction for AGI, decreasing AGI, is going to be better than one after AGI. So part of self-employment taxes, 50% of self-employment taxes are deducted for income tax. Contributions to a retirement plan, IRAs though, not Roths. Only IRAs you get a deduction for. Health savings accounts, interest on student loans, and note that there are limitations for all of these and more rules, but we're going to go over them more generally right now. Excess capital losses, that's a new one. Certain alimony payments. So AGI is an important subtotal, like I said, because it's this basis for calculating other amounts. So it's used to calculate a lot of the itemized deductions. And we used to cover itemized deductions extensively. I find it less necessary now to go so detailed into them because so many people are not going to qualify to take them now. So for example, medical expenses, it's actually limited. The amount you get to deduct is limited based on a percentage of AGI. It's fairly high, 7.5%. Charitable contributions, you can pretty much take charitable contributions. It's a high percentage. Casualty loss is at 10% percentage. See, we see 10% here. 50% of AGI, that's pretty big for the charitable, but for medical, it's pretty difficult to spend more than 10% of your income, and you only get more than 10% of your income as a deduction. So deductions from AGI include the greater of the itemized deductions or the standard deduction. Like I said before, it's either or, and personal exemptions and dependency exemptions no longer count. So when they say, so if you head into the irs.gov here on a browser, I would open it up right now, follow along. We're going to scroll down here and you see forms and instructions, 1040 and schedules 1 through 6. We're going to come in here and we're going to click to see the current year form 1040. I just press Command and click it so it opens in this next page. Now, before we look at this, we're going to come back over here and I'm going to open up the prior year form because it's going to help you understand. So to find prior year forms, you'll go Other 1040 Schedules. We'll scroll down. Oh, let's see. We'll go Prior Year. Form 1040. Can search any form in here. Here's Form 1040 2018, 2017. So let's look at 2017. So here you can see this is page 1 of the form. And this line down here, this is AGI. And so our above the line deductions were up here, and any amounts that decrease the income reported here. So you can see this is our personal information. This is filing status, which we're going to talk about in a moment. These were exemptions, the personal exemption and dependency exemptions, which we no longer have. This is income, like your W-2s and stuff go in this first line. And then these are specific deductions for this AGI. These were the above the line deductions. Then our page 2 of the Form 1040 started with our AGI again. And here we have our itemized deductions or our standard deduction. So the standard deduction is listed over here, and it's based on there's an amount for single, there's an amount for married filing joint, and there's an amount for head of household. And that's it. And so you compare your itemized deductions to this amount, and whichever one is bigger, you get to deduct. Now, these deductions are called from AGI because they're below this line on the tax return. Then everything else below this, I'm going to come back to these itemized deductions from Schedule A in a moment. but everything else below this is taxes, and then the offsetting of your estimated taxes withheld on your W-2, or payments made, or tax credits like the earned income credit. And so down here, if the total amounts you paid in plus the total of your credits is more than your total tax here on line 44, then you'll have a refund. If your total tax is more than credits and amounts paid in, you will have an amount due. All right, so now that you understand this was the traditional two-page Form 1040, we're going to look at the current year form. What happened is they actually divided that two-page form up into 2 half pages plus 6 schedules. So they took this 2-page form and they actually made it 8 pages. Pretty bizarre, I know. And now you can probably understand why I showed you that form first, because now we just have our information on the first form. We still list dependents because we still care about dependents for some credits. And on the second page, we have a few income items, which gets us to AGI on line 7. But on line 6, for all other income items and deductions for AGI, we have to look at Schedule 1. So we'll come back into 1040 and the schedules, and now you can see if you have the amount listed here, then you need a schedule over here. And these schedules are all literally just sections from the old Form 1040. So we'll see our Schedule 1 here. These are all other income items that couldn't fit now because we only have 5 or 6 listed here. So any other income items are listed on Schedule 1, and any adjustments for AGI are listed here. You can see these were coming right from here. They look very similar. And so now that's attached as a schedule on Schedule 1, and any amounts coming from there are netted together and entered here, and then netted with line 6. And then down here on line 7, we have our adjusted gross income. So our standard deduction or itemized deductions, the itemized deductions are on Schedule A, and we're going to go back to our presentation here, and they include medical expenses that only exceed 10% of AGI, state and local income taxes or sales taxes. Unfortunately, these have been limited. Real estate taxes also now limited. Personal property taxes limited. None of these used to be limited before the 2017 changes. Interest on home mortgage, so if you pay a mortgage, the interest. Investment interest. Charitable contributions within some fairly high limitations. Casualty and theft losses, but only greater than 10% of your income, and only $10,000 of combined state and local taxes is deductible, and that's a big reason why people are no longer qualifying. So things that are never deductible: personal living expenses, employee business expenses. These are not, they're listing the old ones. Employee business expenses used to be allowed in some circumstances, unreimbursed. I don't know why it says unless reimbursed. They were unreimbursed employee job expenses used to be deductible, but it was so rare for someone to actually be able to deduct them because it was limited to 2.5% of your AGI. Most investment expenses are actually not deducted. It's only a specific few. Tax return preparation fees, and losses on the sale of personal property, and hobby expenses. So all of these were called part of miscellaneous itemized deductions that were limited to 2.5% of AGI. They are no longer allowed. So I think that's fine. However, all hobby income is taxable, and now hobby expenses aren't even allowed with the limitation. Life insurance premiums non-deductible, gambling losses, child support payments, fines and penalties for any purpose, never deductible, political contributions, funeral expenses, capital expenditures. So our standard deduction is typically one amount that was listed on the left side of the tax return we just looked at, but sometimes there's two components. So the basic standard amount is allowed for every taxpayer based on their filing status. The additional standard deduction is available for people who are over 65 or, and if they both apply, blind. So the basic standard deduction amount depends on the filing status. You can see them listed here. A single person had a standard deduction amount in 2018 of $12,000, and in 2019 it's $12,200. Married filing joint is double that, so it was $24,000, now it's $24,400. Surviving spouse, $24,000, $24,400. Head of household, $18,000, $18,350, and married filing separate is the same as single. So you can see here, oftentimes you won't see married filing separate or surviving spouse listed for other reasons when we bring up filing status, but that's because surviving spouse is typically the same as married filing joint. You can see those numbers here are the same, and married filing separate is the same as single. We'll talk more about that in a moment. Now, the additional amount for being 65 or over or legally blind or both is $1,300 or $1,600. And again, someone can get two of those if they qualify for two. So here's an example. A taxpayer is single, blind, and 65 or older. So the standard deduction amount is $12,200 plus $1,650 for being over 65, additional standard deduction plus $1,650 again for being blind. So his total standard deduction is $15,500. So now if we look at taxpayers who are married, filing jointly, one blind, both age 65 or older. So in this case, we start with the base amount, $24,400 for a married couple. Then we're going to add in, if we look at that table, since one is blind, because they're married, the amount's $1,300, not $1,650. So we have $1,300 for blind, $1,300 for over 65, $1,300 for the other spouse being over 65. So $28,300 total. Now, certain individuals cannot use a standard deduction. It's married filing separate if the other spouse is itemizing. And those itemized deductions are all those ones we listed: medical, charity, and a lot of state taxes. Non-resident aliens don't qualify, and an individual filing a return for a tax year of less than 12 months because of an annual change in accounting period is not very relevant. And the one other situation where a standard deduction might be different is a dependent, a child that has a lot of income that they didn't work for. So an individual claimed as a dependent has a basic standard deduction in 2019 limited to the greater of $1,100. And remember, this is a child with income, so this is passive income, or $350 plus earned income, because this is limiting families from putting their investments into a child to reduce the amount of taxes that are paid on their income. Okay, so examples of this one. This one is more complicated. A blind child earns $200 and is claimed by parents as a dependent. So the standard deduction, we start with the child base amount, $1,100, and we add in the additional standard deduction for being blind, which equals $2,700. And the $1,100, right, was $900 plus the $200. A child who earns $1,500 and is claimed by parents as a dependent. So here we have the greater of 1,100 or 350 plus earned income. So I'm sorry, I said that wrong up here. Greater of 1,100 or 350 in this situation would have been plus 200, so 550. So 1,100 is greater, right? So then down here, same thing, greater of 1,100 or 350 plus the earned income of 1,500. So 1,850 is greater, so that's what we start with for the standard. A dependence standard deduction in 2019 tax year, a child who earns $11,800 and can be claimed by parents as a dependent. Now, the standard deduction comes to $12,200. So we got to do our test again, right? Greater of 1,100 or 350 plus 11,800. This is wrong. I guess they meant for this to be 12,500. So child earns 12,500 plus 350. That would be 12,850. 11,800 plus 350 would have been 12,050. And so the greater of 1,100 or 12,050, 12,050 would have been our standard deduction because it's less than 12,200. But the point, I think, of this one was supposed to be just over 12,200 so that you could see that you don't make the standard deduction more than the single taxpayer amount. All right, so our personal independence exemption amounts are zero. Starting in 2018, the tax changes made them zero. However, the amount it would have been $4,200. For dependents, there are two sets of rules to qualify as a dependent. A dependent is someone that you take care of or that a taxpayer takes care of, and they're called the qualifying child rules or the qualifying relative rules. There are overlapping tests, but with different criteria for each of these rules to qualify as a dependent. So even though we don't get a dependency exemption anymore, we still care about this for things like the child tax credit. So these are the tests or rules. One is relationship, residency, where if they lived with you or not, their age, the support test, meaning who paid for the person's support, whether it's the dependent themselves or the taxpayer who's claiming them as a qualified dependent. So these rules have tried to be established. Head of household filing status, earned income tax credit, and child tax credit. So these are all different situations where the qualifying child has or should have the same rule. They've tried to make it the same rules so that once you qualify for one of these, you qualify for all four of those, including the credit for child and dependent care expenses. So if you pay for a dependent to have care while you work as the taxpayer paying for the care, you can get a credit for those expenses. So the relationship test, that's our first test. For the qualifying child, the child must be the taxpayer's son or daughter, stepchild, brother or sister, stepbrother or stepsister, half-brother or half-sister, or a descendant of any of those individuals, so a child of any of those individuals. A child who's been adopted or whose adoption is pending also qualifies. An eligible foster child may qualify, but they must be court-ordered foster. So the residency test for a qualifying child, the qualifying child must live with the taxpayer for more than half of the year. And you can't say, oh, me and the ex-parent, we split the year. Someone had to have the child for an extra day, typically. When there's 365 days in a year, someone had the child more. Temporary absences don't count, such as illness, being in a hospital or facility, or being away for college or education. They don't count. And for the age test for qualifying child must be under 19 or age 24 if a full-time student. A full-time student simply has to be enrolled in school full-time for at least 5 months out of the year. And it has to be a qualified school or program, and you can look that up. Individuals who are disabled under qualifying child are not subject to the age test. So a disabled child can be a dependent their entire life. Qualifying child must be younger than the taxpayer claiming him or her. So we're going to go back to our original example here. Remember, we had Paige, the family friend. Oh, Paige was the daughter, stepdaughter. So does she meet the requirements as a qualifying child? She was a stepdaughter. So Paige does satisfy the relationship and residency test, but the answer to the age test remains unclear because we didn't have that information. But since she is not a full-time student or disabled, she must be under age 19 to qualify. To be a qualifying child, the individual must not be supporting themselves. This is the support test. If they provide more than half of their own support, then they can't qualify as someone's child. Typically, this will only happen if the child has trust funds. In the case of being a full-time student, scholarships are not support, which is a big one. Tiebreaker rules. So in a situation where a child might qualify as a qualifying child for a dependency from more than one person, there are what called tiebreaker rules. And so we give priority to who gets to claim the child first. So if one of the parents are a parent, one of the people who are trying to claim the child as a dependent are a parent, the parent wins. If they're both parents, then the child lives longer with one of the parents, then the parent, which is called the residency parent, will win. If both persons are the parent and the child lives with each the same amount of time, or neither, then the parent with the higher AGI wins. And if none of the people are parents, then the person with the highest AGI, again, will win. Qualifying relative. So these are two tests you definitely want to have in your notes. Your qualifying child test and then your qualifying relative test for your cheat sheet so that you can refer back to this. So I would make like a graph. I'm sure it's probably in your textbook somewhere. Qualifying child, qualifying relative, list the tests because they're pretty much the same test, and then you can fill in the criteria. So a qualifying relative can be a dependent if the following tests are met: relationship, gross income, support, and support tests. But we also have some of the same criteria. So the relationship test for qualifying child is bigger. We allow more people, descendants, ascendants, so going up the family tree, in-laws, and unrelated people who live with the taxpayer, but they have to live there all year, which we'll see in a second. So we'll go back to the big picture. Is Tara a qualifying relative? So she could be, right? She was unrelated. So she could qualify. And since Tara is a dependent, Aleja, the taxpayer, can also claim medical expenses if she paid them on Tara's behalf. But funeral expenses are not deductible. So the dependent's gross income must be less than the exemption amount. So there's no personal and dependency exemption amount, but it was going to be $4,200 for 2019 and $4,150 for 2018. So if we go back, if we assuming that Paige is not a qualifying child, can she be a qualifying relative? So that was a stepdaughter, right? So she meets the relationship and support test, but gross income test. So if the income from her part-time job is less than $4,200 in 2019, then she would qualify as a taxpayer's dependent. Now, the support test for qualifying relative is that the taxpayer must provide more than 50% of the qualifying relative support. Relative is qualifying relative support. Or unrelated party who lives with the taxpayer all year. We haven't gotten to that part, but only amounts expended are considered in the support test. So basically you take up all the support that was spent on the qualifying relative, and the taxpayer who wants to take the person as a dependent must have actually paid more than 50%. Scholarships do not count because they're typically going towards college expenses. There are two exceptions to the support test. In multiple support agreements, and this comes down to often divorced parents and children of divorced parents. Multiple support agreements are specific agreements, legal agreements that allow to designate one member of a group to claim the individual as a dependent, even though no one person provides more than 50% of the support. So that's a multiple support agreement. Collectively, the group that's designating one member of the group to get the deduction must provide more than 50% of the support altogether. And eligible parties must provide more than 10% of the support to qualify. You can't take it if less than 10%, and they must meet all of the other requirements. So, example, children of elderly parents are able to claim an exemption for the parent when no one individual meets the 50% support test. Children of divorced parents, special rules apply if the parents meet the following conditions. So they would have been entitled to claim the individual as a dependent child if they had been married and filed a joint return. They have custody, either jointly or singly, if the child for more than half the year. Under the general rule, the parent having custody of the child for the greater portion of the year is called the custodial parent, and they are entitled to claim the dependent. However, the general rule does not apply if a multiple support agreement is in effect, where essentially the custodial parent has signed away their right to take the child as a deduction. This rule countered in divorce agreements. Typically, the person who had the more money would write into their divorce agreement that they could deduct the child, and oftentimes the other parent was the custodial parent. And so Congress said, no, hands down, custodial parent gets to take the deduction if the child stays with them. So the multiple support agreement, the general rule is this rule doesn't apply if a multiple support agreement is in effect. But remember, everyone had to agree to the multiple support agreement, which means that the custodial parent gives away that right. Okay, so other rules for determining dependence. Yes, aren't these quite extensive? So in addition to fitting into either qualifying child or qualifying relative, a dependent must also meet the joint return test, the citizen or residency test. So the joint return test. A dependent cannot file a joint return unless they do so just to get a refund from taxes that were withheld. There's no tax liability for either spouse. So that total tax line on the return that we went over, it's 0. And they had taxes withheld from their W-2, they just want to get them back. Now, the citizen or residency test is that the dependent must be a U.S. citizen or resident of the U.S., Canada, or Mexico for some part of the calendar year in which the taxpayer's tax year begins. So that's looking at the person who's going to claim the person. For 2018 through 2025, a taxpayer may not claim a dependent tax credit unless the individual is a U.S. citizen or U.S. resident. So that's new. It used to be a U.S. citizen or resident of U.S., Canada, or Mexico. An exception provides that an adopted child does not need to be a citizen or resident of the U.S., as long as his or her principal home is with a U.S. citizen. So of course this is aimed at illegal immigrants. So tests for dependents. This is a summary of those that I mentioned you would find in the book for your cheat sheet. Writing it out will probably help clarify. If it sounds like a lot, it is, but writing that out can really help. So child independent tax credits are provided to individual taxpayers based on the number of their qualifying children and dependents. So for example, a $2,000 tax credit is allowed for each qualifying child, including stepchildren and foster children. To be eligible for the credit, the child must be under 17, a U.S. citizen, a dependent of the taxpayer, so meeting all of those rules. And in addition, they must have a social security number. So a $500 tax credit is allowed for each dependent of a taxpayer other than a qualifying child. So that would be qualifying relative. Examples would be children over 16, including full-time students under 24, children without a social security number, parents of the taxpayer, and other members of the household, non-related dependents. And for purposes of this credit, the qualifying relatives must be U.S. citizen, U.S. national, or U.S. resident. So the child independent tax credit are subject to a phase-out once the taxpayer's AGI reaches a threshold. So once that amount becomes so high, I think it's 200,000, then the credit phases out. Now, there's a refundable portion of the child tax credit. So the child tax credit is essentially two credits, one that's non-refundable and one that's refundable. For all taxpayers without qualifying children, for all taxpayers with qualifying children, regardless of how many, the child tax credit is refundable to the extent of the lesser of $1,400 of the child tax credit for each qualifying child, or 15% of the taxpayer's earned income in excess of $2,500. So the $1,400 amount is adjusted for inflation, so it will increase, and the $2,500 amount is not adjusted. So this amount will decrease over time. The dependent tax credit is non-refundable. So now we're going to talk more about these filing statuses that we've mentioned. Single, married filing jointly, surviving spouse. Now, these five filing statuses, everyone has a filing status, and it's based on the last day of the tax year. So as of December 31st, what was your status? Were you single or were you married filing joint? If you were single as of that last day, you're single. It doesn't matter if you were married up until December 30th, and likewise, if you got married on December 31st, you're married filing joint on your tax return. Surviving spouse or qualified widow or widower basically allows someone, when they lose a spouse, to file as married filing joint for another 2 years as long as they have a dependent child. And the reason this is beneficial is because, as you'll see when we get into problems, married filing joint is two people paying the same amount of taxes as a single person. And this is why the LGBT community got very upset about not being able to file married filing joint for taxes. They were essentially paying substantially more in taxes than other couples. And that had a big reason to do with why that issue was legally changed, because it was unfairly burdensome. Although that is not often heard in the conversation, it was a tax issue. Okay, head of household, similar to surviving spouse, head of household is for when there's one parent maintaining a household with dependents. Married filing separate, if you're married, you have two options: married filing joint or married filing separate. No other options apply to you. Filing status affects your tax rate bracket, standard deduction amount, and other amounts in the calculations. So I basically just went through all these details. Surviving spouse is the same tax bracket as married. and it qualifies for 2 years as long as they have. So head of household filing status must be unmarried as of the end of the year, or they're very strict qualifications, but someone who's married can qualify as long as they have not lived with their spouse and they're considered abandoned. Now, they must actually pay more than half the cost of maintaining a household, which is the principal home of a dependent, for more than half the tax year to qualify. And a dependent must satisfy either the qualifying child or qualifying relative rules, of course. That's why we covered all of those rules. And a qualifying relative must also meet the relationship test. So back to our big picture example here. Assume that our taxpayer A can be treated as single because, remember, her spouse left her. So can Tara qualify Aleja for head of household filing status? Can the unrelated person who was a dependent qualify the taxpayer for head of household filing status? Good question. Remember, her unemployed spouse abandoned her. The answer is no. Why? Even though Tara can be claimed as A's dependent, she does not meet the relationship test for head of household status. So they can't be a random person to qualify for head of household. It has to be related. So head of household status may be claimed if the taxpayer maintains a separate home for his or her parents. This is one other exception. At least one parent must qualify as a dependent. And for the abandoned spouse, it allows a married taxpayer to file as head of household if the taxpayer does not file a joint return, paid more than half the cost of maintaining the home, and the spouse did not live in the home for the last 6 months of the tax year. And the household, of course, was a principal residence for the taxpayer's child. And they actually qualify to claim them as a dependent, of course. So back to our big picture example. So can Aleja qualify as an abandoned spouse? We said he left during the year. So yes, if she can claim Paige, either qualifying as a child, qualified child, or qualified relative rules, because she meets the relationship test, then she could qualify for head of household under abandoned spouse. Otherwise, if she doesn't qualify for head of household, then she would be married filing separate because she can't file with her disappeared spouse. So for filing the return, our general rules is that a tax return must be filed if gross income is equal to or exceeds the standard deduction, right? So if you have $10,000 in income, the single standard deduction is $12,200. You don't have to file, but if you had income taxes withheld, you probably want to file to get those back. The additional standard deduction for being age 65 or older is considered in determining that amount. So you have to go through that same process we went through before to calculate the standard deduction to know what the threshold is that requires a tax return. So except in the cases of dependents, the additional standard deduction for blindness does not apply. So special rules apply for dependents and self-employed taxpayers. So all taxpayers start with Form 1040, and then based on what they have, they'll need to attach Schedules 1 through 6. Starting in 2019, there's going to be a new tax form for individuals age 65 by the last day of the year. 1040 SR will focus on retirement type activity. So when do we file the return? It's due on or before the 15th day of the 4th month of the taxpayer's year end. Now, most individuals have the calendar year, so 12/31 is the last day of the year, calendar year. 4 months, 15 days later is April 15th, the infamous April 15th. You can get a 6-month extension of time to file the return But that does not extend the time to actually pay the tax. So even if you don't know how much you owe, you can just pay in some money if you think you're going to owe when you file an extension to pay the return later. So all of the instructions are on returns for where to file. There's an address where to mail your return if you're mailing it in based on where your address is. But most returns these days are, of course, e-filed. You can pay online or make out a check to the United States Treasury. Usually there's a direct payment made through your bank account or debit or credit or electronic transfer. So tax computations. Tax liability is computed under two methods. There's the tax table method or the tax rate schedule method. Now, anyone under 100,000 uses the tax table method, and so there's $50 ranges into which your taxable income falls, and you'll choose the amount based on your filing status. The tax rate schedule will actually times rates to calculate the amount. Okay, so for 2019, the tax rates are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. And these are 2019 income individual rates. Now, unearned income of dependent children. Net unearned income of a child is taxed using special rules. Why? Because parents, wealthy parents, are putting money into their child's name to probably try and lower their income. So this was to avoid that. Children must be under age 19 at the end of the year or 24 if a full-time student. NUI, as it's abbreviated, equals unearned income of more than $2,200 during 2019. And so it's going to be subject to the kiddie tax if they exceed this amount. So a child with no earned income and low taxable income, if the child has no earned income and no more than $3,700 of taxable income, child's tax rate is 10%. They essentially have lower income brackets than earned income. Child with earned income, if a child has earned income, a modified single tax rate is used. If a child has both interest income and qualified dividend income, QDI, in net unearned income, which is usually what it's made up of, then the interest income is taxed at ordinary income rates, and the qualified dividend rates, along with net capital gains, have the preferential tax rates called 0%, 15%, and 20%. So we'll learn more about these. Qualified dividends are taxed at preferential rates if they're held long term. Gains or losses from property transactions. So property transactions is anything you own, like a vehicle, investments, a house, dividends, stock. And property transactions, when you buy a piece of property, you're buying it for a particular use. That's why you own it, right? Personal use, investment use, or business use. Based on that use is how it's treated for taxes, if you have income because of that property, and when you sell it, everything you get minus your investment in that property equals a gain or a loss. Now, I don't like how their slides go over this topic, and I've gone through this thoroughly in another video, so I'm going to link that video below. But I certainly give a good intro just in the first 20 minutes of that video, so you can check that out. And I go over this in that video, but these are those preferential rates for this term that you see a lot called net capital gain. So typically we talk about this in response to dividends, right? Dividends are what, when you have investments, so you bought shares in a company, or you just have mutual funds or retirement plan, they're buying shares in a company on the stock market. And so when you buy and sell those shares, you're having what's called gains. and they're taxed at a preferential rate of 20%, 15%, or 0% as long as they're long term. Then there's a lot of other rules, of course, but that's the most important part, and do watch those other videos. Additionally, you can deduct up to $3,000 per year of net capital losses. So now back to this big picture. She sold her wedding ring and it resulted in a realized capital loss. Now that's presuming that a wedding ring was bought and held for investment purposes, which I kind of have trouble believing that. I would say that it was personal use. So regardless, she had sold the ring for $9,000. That was the amount she realized, minus the cost basis, what they paid for the rings, $11,800. And so that gives us a capital loss of $2,800. So because they were personal use property, A cannot deduct the loss. So personal use is not deducted, and it would be taxed if there's a gain, but it's not often that personal use property goes up in value. If you buy a vehicle, right, over time, you sell a vehicle for less than what you paid. If everyone sold the vehicle for more than what they paid, that would be great, but that's not the way it is, right? So A's major concern, we're going back to our example, is her filing status. If she qualifies as abandoned spouse, she is entitled to file as head of household, which would be good. If not, she has to file married filing separate. So in order for her to be an abandoned spouse, she must claim Paige as a dependent. That was her stepdaughter. So to be a dependent, Paige must meet the requirements of qualifying child or qualifying relative. For qualifying child, Paige must either meet 1, the age test under 19, or be a full-time student under age 24. If she's not a full-time student, is she under 19? If so, she's a qualifying child. If Paige is not a qualifying child, though, could she be a qualifying relative? Here, the answer depends on the gross income test, right? How much did Paige earn from her part-time job? If her earnings are less than the personal exemption amount, which we no longer have, of $4,200, then she satisfies that test. All right, if Paige can be claimed as a dependent, then A is an abandoned spouse entitled to head of household. If not, she's married, filing separate. So Tara can be claimed as A's dependent because she is a member of the household, but it doesn't matter that she died in February. So whenever someone dies during the year, the dependency exemption, which we don't have, isn't apportioned. You just get the full amount. So she qualifies for any of those other purposes. Because Tara is her dependent, A can claim the medical expenses she paid on T's behalf, but funeral expenses are never deductible. Does Tara qualify A for head of household status? No, right? We already covered that because she doesn't meet the relationship test, which was a specific tweak to the qualifying relative, specifically for qualifying for head of household. So I know that gets complicated. Sale of wedding ring, capital loss of $2,800, not deductible because it's personal. Okay, guys, great job. Do let me know if you have any questions. Otherwise, I'll see you in the next video.